Most people assume that wealthy investors allocate money to alternatives because there's simply better returns there. Well, that may be partially true, and that's not the entire case. Here's a better way to think about it. People invest for a whole variety of reasons, right? They can be anything from one, cash flow, two, growth, three, the option for liquidity, and four, they can invest for tax purposes. And lastly, when looking at the ultra wealthy, this is more for purpose and fulfillment as to what the intention investment is actually for. And for the really wealthy, there is a fifth one. It ties into both purpose and into their legacy they'll leave behind. And every investment decision that they make, it ties into what purpose does this capital have for right now? What do we need to go solve with this type of money? And what wealthy investors have figured out is that the public markets can serve some of these initiatives, but not all of them, and not all of them well all the time. So in turn, they look to go use alternatives to go fill the gap they have. And let's break each one of those reasons down. Number one, and the most simple to understand in my opinion, is cash flow, right? Cash flow you can go use to live off of, right? The distributions, the earnings you have from there, right? These are dollars you can go take out of your investment that you can go use for everyday life. This is capital that needs to be put to work right now and actually giving you a return versus someday way in the future. Next is growth. This is for capital that you do not need today. And in turn, you're looking to go achieve the highest level of overall return. Even if you're sacrificing the short term, you're looking at the overall exit outcome of this, right? In terms of total growth. So this allows you to go leverage the eighth wonder of the world tied to compound interest. Third, people look for liquidity. This is capital that you can go allocate, earn some level of return on, and still call it back when you need it in the short term. And this money, the intention of calling it back is that you won't take on a massive loss, you won't take on a huge hit by having your capital returned to you. This really ties into optionality and for flexibility. Next is tax efficiency. So when you are extremely wealthy or you're extremely high income, this is likely your largest expense. So when looking at investments that have a focus on tax efficiency, your goal here is to be able to go keep more and give the government less of what it is that you're earning, right? Legally, strategically, this is a crucial issue to go solve if you're an extremely high earner or if you're very, very wealthy. And I'd say this last one is really tied for those folks who are very, very, very wealthy, right? They have made it entirely. And I look at this as purpose and legacy. This is tied to either investments that you believe in that align with your life mission, vision, values that you want to go help support and provide for, or alternatively, this is something that you want to go outlast you. Maybe it's your family history. Maybe it's something that you want to be known for. So again, purpose and legacy is the fifth component of looking at the 5 reasons that people typically invest. And here's the key thing to think about as well, is that each investment you do likely will not cover all 5 of these areas in one, right? You have to look at each bucket of capital that you have and the problem you're looking to go solve for at that time. Is that if you're getting 1 or 2 of these components, you're likely trading off in a certain way. For example, if you're prioritizing cash flow, you likely are sacrificing growth in the long term, right? But it matters what it is you're looking to go solve for at that time. For example, public markets, stocks, bonds, ETFs, right? They're great for liquidity. You can go have your capital back typically in a few days. They also provide opportunity for growth. They're also extremely transparent and accessible, but they're not great at everything that they do. And as your wealth grows or your goals shift, you may look at things out of the public markets to go solve the problems you're currently facing and the goals that you actually have. Now, let's look at what actually happens. So one of the best databases that we have as an example is the Tiger 21 network. So they are a community of 1,500 plus people that are all $20 million plus in liquid net worth, meaning they have that invested. The average net worth is close to 100 million in their community, and they publish, aggregate all of their data every single quarter. So we can go look for that for key insights as to how the wealthy truly allocate their capital. Across their membership portfolio, what we've seen historically is that alternatives typically take up over half of the actual portfolio itself for the bulk of their members. Whereas for the public investors, public equities, which typically dominate for the traditional retail investor, make up a much smaller portion of their portfolio. And the pattern is typically consistent. As the portfolio grows in size, they typically become less and less liquid. In turn, more of their money is moving to these alternative private investments. Now, if you're thinking about purely growth and liquidity, this seems counterintuitive, right? You are giving up the ability to earn a 8, 9, 10% historical return. And in turn, you're then locking up your money for a longer period of time in less liquid opportunities. I really think the answer, though, ties to that growth and liquidity aren't the top priorities anymore. And at a certain level of wealth or a certain position you are in life, it really shifts from growth and liquidity to cash flow, right? Because you're typically living off the portfolio itself. So if you've heard wealthy people speak, this may tie to hearing someone, how much you make a year, to how much are you worth? That conversation itself amongst very well people starts to shift. And because most wealthy folks, they're actually living off of that portfolio level income they have right in their cash flow from their investments itself. And then also the big piece for them too ties to tax efficiency. So when your portfolio is a substantial size, every point you're saving in taxes is dramatic when thinking of the total net value of cash flowing them through to you as the investor. And lastly, once you've reached the point of you really can't spend the money that you have, right? The wealthy tend to start thinking of purpose and legacy, which we'll cover here later as well. Now, let's go through each of the investment goals and see where the public markets does well and where they truly fall short. First, let's look at growth. And think of growth, but more so with control. So alternatives can offer growth, but in different structure than public markets. So private equity, private credit, real estate type deals, other types of growth deals. These are equity-like in their return potential, but they offer something that the public markets really don't. And that is the ability to go select the manager, to negotiate your own terms and access opportunities that are not available to everyone. This is much more so of a who do you know type game. And there's a big trade-off though. The trade-off ties to illiquidity and to higher minimums. But this is for capital that is much longer in term. And that trade-off is something that you're willing to go do. Now let's cover the purpose and legacy component. So for families who have really achieved that massive wealth that are $50, $100 million or more, purpose can come to be a central question that is they're asking. That money may have exceeded an amount that you'll spend in your entire life, that your kids will spend, and maybe their kids will spend too. At that point, growth may not be the primary goal anymore. It may still be there, but it may not be the primary goal. And the question you can start thinking about is, what is this wealth actually for? And that's where alternatives can offer something that the markets really can't, right? Direct investments in businesses that you believe in, not because the return itself is better, but because you believe what the business is designed to go do. This can be anything from buying real estate in areas that you grew up in, buying businesses that your family had a hand in previously, or this can be anything to go help the climate, education, healthcare, whatever it may be. And most importantly, it helps bring this into the next generation of people. And again, for those who are listening who may not be at this place just yet, this is something to go think about when you get way in the future to go accomplish this level of optionality, right? This isn't meant for people who are just starting out. This is for the families who have truly gotten to that place. They can go be very intentional about how it is they're allocating their capital going forward and understanding what is wealth actually for. Now, lastly, you're all thinking it, I want to go cover liquidity, right? This is the biggest piece here is that alternatives give up liquidity in a huge way for all the benefits we've listed here previously. Some deals are short-term where they are months at a time, and some deals are years and years and years, not decades going forward. So once your capital is in, you are entirely committed to that deal. But it's a big trade-off that you're doing. You're giving up the option to go pull out your money, but you're getting potentially control of the manager, cash flow, taxes, potentially purpose in the deal itself, right? And potentially growth as well too. So it's a trade-off that you have to decide if it's worth it for you, right? You're giving up that liquidity, but you're getting something else somewhere instead. And if you can't handle giving up the liquidity itself, like these investments are not for you, this is the biggest thing to go think about is that if you cannot handle giving up liquidity or you need that capital back in a certain period of time, no matter how good the deal is itself, it likely is not worth giving up that access to your capital that you may need in that window of time too. Let's dive into what can go wrong. Really important caveat here is that alternative investments are not always safer. In fact, they may actually be riskier as they're less regulated. Most alternatives are not as deeply regulated as the public markets in terms of audits, in terms of financials, in terms of all those things. You also have manager risk, which is a massive component of this. In public markets, you're betting on the company deliver, and you're also betting on broad economic growth. In alternatives, you're often betting on certain people's judgment, their integrity, their ability to execute, and that's a whole different kind of risk versus betting on a specific company in the market that's already public. Another thing to note here too is that in the alternative market, there is very rarely a secondary market for deals. So what this means is that if you run into a time in which you invested money into a 7-year fund and a year of 3 hits, you need the capital back, there is likely not an exit for you. If there is, it's likely an exit you don't want to go take. What we've seen is that you'll have a substantial haircut on your investment to get your capital out of that deal typically. Another component here to look at is that fees and structure are both less transparent and typically more aggressive in this type of space, where in the public market, things are very disclosed. In the private market, there's a lot of different nuances in terms of fee structures and compensation that you need to very carefully read through as to understand how it is that things are structured. And like anything, right, there is fraud that exists in private markets in ways that it's not in the public markets as well. There's less regulation, there's less transparency, fewer sets of third-party eyeballs are typically reviewing these types of deals. So when you look at investing into a deal, due diligence is a massive, massive, massive component of it, right? The entire thing that you're doing is you're betting on the jockey, not the horse, in a deal like this. So these trade-offs are big, right? Like you're putting all of your capital and your trust into, one person, a small group of people, and there's a huge amount of trade-offs that you have between liquidity, between disclosures, between the optionality you have. So those are all things to consider when looking at making an investment into a private type deal. Let's cover how the institutions really think about this. So here's how sophisticated allocators actually structure their portfolios. They don't start with asset classes. They start with what purpose is this capital for, right? They ask, is this capital for growth, for income, for preservation, for liquidity, for legacy? And they match investments to go align to those purposes. The first thing to cover and to understand what tolerance you have and how much you need is liquidity, right? You never want to be a forced seller of a company, of a real estate deal, of a private investment in general, because that's how you have the biggest risk is if you become a forced seller due to liquidity. And liquidity can be covered in a variety of ways. It can be covered in money market accounts. It can be covered in public markets. It can be covered in short-term private credit, depending on what it is that you want to go do and what your tolerance of risk is and how quickly you need the liquidity, right? There's always different buckets too. This can be same-day liquidity, 3-day liquidity, 1-month liquidity, 3-month liquidity, 1-year liquidity. So all things to go think about as to what duration that liquidity actually is that you need to go solve for. And it's a really important thing with this as well too, is that each piece of capital that you have has a certain job. And each investment is chosen because it does that job well. Some capital can have 1 or 2 jobs, some can have 2 or 3 jobs, but it's important to understand that each piece of capital allocation is crucial to understand what is the intention behind what that capital is doing and what it's looking to go accomplish. And now let's make this concrete by giving an actual example. Now let's take a family, say they have $25 million, right, in investable assets. They have all their stuff covered in liquidity. They've got cash reserves, they have no debt, their kids are already through college, and they're people who aren't trying to go grow their wealth to 50 million. All they want is they want to have income to go fund their lifestyle, tax efficiency because they're in the highest tax bracket, and they're starting to think about how can I involve the next generation that I already have to make sure the capital gets deployed in a really efficient way and then passed down to them efficiently. Their portfolio could look something like this, right? Maybe 30% in public equities for growth and liquidity. That's the engine that allows them to have accessible capital when they need it. They may then choose to put, say, 25% into private credit, right? This can go help them provide meaningful cash flow to go live off of as they understand their budget numbers, right? That can be predictable, consistent income for them to go truly live off and kind of build a life around. Maybe they have 20% in real estate, and that is the intention of paying down quality properties, but more efficiently, it's for depreciation. This allows them to go have income that is extremely tax efficient and also leveraging depreciation they can use in other areas of their business and portfolio. Next, maybe they have 15% in private equity type deals or a fund. This can be a deal that is from 5, 10, 15 years, and they're looking at it from a really long time horizon. They won't need that capital back, and they can go all in on growth in that component of their money. And the last 10%, maybe this is businesses they actually own themselves. They truly operate or have some of their team operate for them. This can be things that they know well, communities they're involved in or care about, but more importantly, things they can go truly pass down to their children. And this isn't some generic template you can go use. It's more so every single family and opportunity is different. And it shows how each of these top 5 priorities actually map to actual locations. And this isn't a template, right? Every family is different in how they operate, right? But it shows how the top 5 priorities can be used and matched to certain capital allocations, right? Each allocation has a certain job. Its goal is to accomplish a certain thing. And the whole goal here isn't to go solve for some specific return number. It's to build a portfolio around what your priorities actually are and the job that that capital has to go accomplish. Let's cover what this actually means for you as an investor. So here's the practical question. How do you know if alternatives make sense for your personal situation? What I would say is start with the 5 priorities. Ask yourself, honestly, which ones matter most right now with the capital that you're looking to allocate today. If liquidity is your primary goal, then likely alternatives are not for you. If your goal is to just set it and forget it, the public markets may make a lot more sense. But if cash flow matters and you need actual income, right, not 2, 3, 4% dividends, then alternatives may be worth looking to go pursue. And say tax efficiency is really crucial for you, right? You're in a high tax bracket. And for you, after tax returns are what you really care about, alternatives may offer structural advantages that you cannot get anywhere else. And if purpose matters to you, if you want your capital to go do something beyond a number, alternatives may let you invest with the best overall intention. And the question here isn't, are alternatives better, right? In some cases, sure. In some cases, probably not. It's really understanding which problems do I want to go solve and what solves them best for this component of capital. The question isn't, are alternatives better? It's which problems am I trying to solve and what solves them best. That's the framework. People invest for cash flow, growth, liquidity, tax efficiency, and maybe way down the line, they invest for purpose and for legacy. Wealthy investors look to alternatives to help them solve some of these priorities better than public markets can. But understanding this component really is just step one. The more important question is whether alternatives actually belong in your personal portfolio. Given your situation, your priorities, whatever constraints you may have. In a future video, I'm going to walk through who should not invest in alternatives, even if they have the capital, even if they're accredited, even if someone else is telling them they should, because saying no to the wrong investments is often more important than finding the exact right ones that you need.